Okay, I'm gonna call the meeting to order. Um, of the Norwood Pension Board for January 14th, 2026. And I'd ask for a roll call, please.
Jim Hendrickson's here.
Carlos Carroll. Second.
Frank Nash.
Dave Kramer.
Fred
Dave
Murdoch
Kramer.
from Callan. Jared Schmidt.
Tiffany Lamb.
Kevin Schmidt from Callan.
Thank you. The minutes from the meeting of December 10th. I wasn't here, so I can't comment on them.
I have one minor edit. So item D, the vote on Robert on the Garland's appeal. The first sentence is missing a word. Went into executive session at 6:38 to discuss. The word discuss should be put in there. Otherwise, I think they're fine.
Any other changes? Is there a motion to accept?
Carl Piro has motion to accept.
Carlos Carroll.
And Jim.
I'd second it.
Second. Okay, we got 2 seconds.
All in favor?
Aye.
Frank Nash, I abstained. I wasn't at the meeting. Thank you. Approval of pension applications. I believe there's one.
Yep.
Does anybody want to? Do we have somebody on staff to discuss it?
Last month, nobody was on to discuss it, so I did it, but.
Okay, you could do it again if you'd like.
So we have one pension, it's for Andrew Garfunkel, town clerk, 10 years of service. He's elected option 1 on his pension. And as designated as beneficiaries, etc. Anyone have any comments on
I move to approve.
it? Me,
Charles Carroll, I move to approve it.
Second,
Jim Hendrickson, I'll second that.
all in favor?
Yeah.
Aye.
Opposed, no. Passed unanimous. Reports, 2025 review.
Yep. So every year we want to, take a step back, review all of the work that the pension board and defined contribution committee have done, as well as try and set some goals and projects for the year ahead. So I think in the first half of the hard copy, the attachment of the work plan, we reviewed fixed income quite a bit at the start of last year. I think we left the fixed income manager search as is for now. We're happy to revisit it in 2026 if desired. We also conducted the small cap growth search. The transition from Principal to Emerald is in process. Jitsame and Callan have been working with the custodian and Emerald, and everyone's been notified. So we're just trying to get through the paperwork and make sure everything's set up for a smooth transition. I think the hope is to have that done by the end of January, assuming no issues. So that's great. In terms of portfolio reviews, we had TCW, PIMCO, and Walter Scott present to the pension board. And then within the defined contribution plan, we had Empower present on that front. Looking ahead to this year, we will get through the small cap transition. One thing that we would like to do is formally review the pension and OPEB investment policy statements, just to make sure that everybody agrees with the current state of both of those statements. I don't think we'd expect wholesale changes or anything drastic, but just good fiduciary cadence to review those. We have Walter Scott presenting next month. And then 3 managers that we thought were worthwhile. UBS, given their issues in the fall with co-investment with First Brands, they have rebounded a bit, and I think that was a lesson learned, but it would be good to hear from them directly. TCW's performance was fine in 2025, improved a little bit from 2024. But it'll be good to have them in maybe later in the year. And it's, probably been a year and a half since we've had ABS present to the board. They have a very good 2025, continues to perform very well. So just having them in to get an update from them on the global equity long short work. And then within the DC plans, we intend to review the fees for the investment options in the DC plans. I think at the next DC committee meeting, we'd like to have Capital Group present a review of the target date funds. They represent a large portion of the total assets in the plans. And then later half of the year, have Empower in to provide their typical review of what's going on with participants and the plans themselves.
What's our contract with Empire? Up to the,
I think it's year to year.
what is it?
It was up end of last year.
Yeah, Empire is automatic renewal
Okay,
on an annual basis.
good.
Yeah, as long as the city and Empire both agree.
Yeah, okay, good.
And I think we did a formal administrative fee review of their fee maybe
Very good.
2 years ago, I
Yeah.
think, and they were reasonable, but we
Yeah.
can certainly revisit that.
Does the city also do a kind of a satisfaction survey of all the employees and see how they like the plan itself?
Sharon, I think you're on. Could you answer that?
To my knowledge, we have not, certainly not since October, but I would be happy to do something.
I guess it doesn't make sense, or is it a question more than knowing whether we should do it or not? Is a question out there?
Yeah, I don't know that the average person, knows anything other than they'll have a pension and, there'll be that benefit. I don't think they're really following. Some might, but I don't think that's the hundreds of employees are. But if we see value in it, I'll be happy to set that up.
Although there might not be many who would like that information, even if there were just a couple, I think it would be something that they should have access to. I think the board would agree with that.
Yeah, I presume employees would be interested in expressing their views on service levels in particular. So, and any concerns with, reporting, anything else?
But I can work with Jared to get that together and send you a copy before we do it.
Okay,
That works.
all right.
Anything that the board would like to add to the work plan or priorities that we missed? We're happy to adjust.
One of the things that I know myself, I'm more involved in ETFs than I have in the past. And Walter Scott is underperformed by 20%. It's 200 basis points. 2,000 basis points. That's like so far off that, even though we haven't had them for very long, and almost all of these, look, Solchester's done well, even though they're underperforming. But some of these funds are so far away from the indexes, whether you take the growth or the index itself or the growth index. Maybe we should consider not having active managers, because right now supposedly net of fees only about 20% of active managers outperform the indexes. So it might be time to evolve into ETFs rather than active managers. I don't know if anybody, what do you think? Anybody?
It goes against what we've always thought. Active managers usually outperform historically, I know.
But they haven't in the last number of years.
And it's been a bit of a wonky market. I know last month we discussed what's going on in small cap US stocks and how non-earning junk stocks have outperformed everything else within the small cap universe. We saw a bit of a reversal towards the end of 2025, which you can see LSV has underperformed. Longer term, they've outperformed, but in the short term, a large driver of that is these negative earning stocks that have outperformed.
Yeah.
And then internationally, Walter Scott, they presented last year, a big driver of the EFA growth index has been companies that they will know, like defense companies, with Europe trying to build up their defense budgets. It was a trade, and what Walter Scott is ultimately doing is trying to find long-term growth drivers, and they're really a quality-focused, long-term investor. And the market, as you can see, has absolutely whipsawed their philosophy and process. That all being said, we can certainly explore going passive. I mean, BlackRock is another manager that has done okay, but has not shot the lights out by any means within emerging markets. We're happy to explore options in what an international equity structure looks like with a passive component. We certainly have clients that do that. And if ultimately the board has lost conviction in active management, then maybe it's time to explore other areas.
What do you think, Dave?
Well, I'm just almost comparing like OPEB to what we're doing here, right? And OPEB largely is ETF or passive based, isn't it? When you look at it from that point of view,
It is, yeah.
Yep.
And it outperforms the,
and it outperformed this, last year, like it really the last 2 years, it outperformed this.
I think it's last 5 years.
Yeah, so certainly it has a merit to say that going in that direction is lower cost and likely to perform as well as this and it can perform better. I mean, and it has actually done that. I would say I'm bullish on the ETF strategy myself.
The question, I think, is just whether or not you believe there's a regime change in the sense that in the grand scheme, 2, 3, even 5 years is a short period of time. And
Yeah.
the longer term history, particularly in the international space, we can have a deeper debate, which I'll probably agree with you more on the domestic side. But the longer term history still suggests that international is more inefficient and there's alpha to be had through active. So I think the question comes down to whether or not you think that there'll be a continuation in the markets that we've seen the last couple of years, such that there's a pretty significant regime change, or if you think there'll be a reversal back to the longer term trends.
Well, one of the things is that ETFs have really come to the forefront only in the last few years. And one of the reasons why is because of their performance. And in a way, to me, the ETF outperforming managers just reinforces the idea of ETFs,
Well,
right? I
I
mean,
think their low fees are what really.
their low fees
You're
are.
all the assets to them.
We put money into, like, when you think about it, right? We have money in our US equities. We're paying what, 4 basis points?
Yeah.
It keeps up with the market.
We haven't seen, there are active ETFs. So ETFs are not all passively
Right.
managed, but we can understand if obviously, I think emerging markets and international equity has historically been an area where the managers implemented have not achieved what the board expected.
Right.
And if the board has lost conviction in that going forward, there are alternatives to implement passively. And we would want to do that in a more formal way where we look at the structure, we look at the style biases and how passive strategy could complement someone like Silchester.
Are you saying that the board lost confidence in all active managers or the ones we have?
So for us, when we look at the international equity managers, Walter Scott. We believe, yes, they have underperformed terribly. And since Norwalk has hired them, they have absolutely underperformed. Walter Scott's investment philosophy and process is still the exact same that had the great track record from when they were hired. We haven't lost conviction in the team or the process.
No.
It's really a market dynamic that we've seen over the last 2 years where all of their strategies have significantly underperformed.
You see that continuing for a long term?
I don't. And I think the one kind of nuance.
Yes.
Okay, you know what the thing is, if the market stays unchanged and they make 25%, we're back to even.
Right.
Because they've lost so much. So to me, I mean, the trend, you know, I have money in maybe in some ETFs like gold index funds or something like that because they could be, but I still trade individual stocks, but we don't do that. And I think that people, I mean, there's an unfortunate reality that, you know, I was with some people who run money, and one of the things they say, listen, it's a dying business. That's the reality.
Active management.
Active management's a dying business. The guy outperformed the S&P by 200 basis points last year, net of fees, and he still said he's losing money because people put it into ETFs. And forget it, like most of them are losing money if you look at our track record for years. So all I'm saying is, you know, what we want is if we have money in overseas markets and they go up 15%, we like to make 15%. We don't want when they're going up 25% to make 5%. You know,
I think the one caveat I would just point out is, you know, a manager like Walter Scott, where quality growth is really their emphasis. They're looking for strong balance sheets, strong cash flows. They will not own speculative names. In a negative market environment, they're going to do much better than any passive fund.
I think the thing
And
is,
if you're okay with that, if you're comfortable with knowing that you're going to follow the market up and you're going to follow the market all the way down when it's down, but that's part of owning the benchmark or owning passively is you.
we have seen people, I remember the first meeting I ever went to, which was pretty comical. They had a guy in and he said, oh, you know, he had all these excuses why he underperformed. And I'm looking at the stuff and he had money for like 4 years. And it was a down period and it was an up period. And in the down period, he underperformed, and the up period underperformed. And so when I said to the board, the chairman at the time, when I raised he goes, anybody going to say anything? Nobody says anything. I raised my hand. He goes, oh, the new guy's going to talk. I go, are we going to discuss and take money away? Are we going to just take the money away right now? And he goes, whoa, what? You know, the reality is there are people who don't, you know, we don't know. Walter Scott might, you know, the people who are bought, say, in the US, you know, similar to long-term growth, steady growers, they've been slaughtered.
Yeah.
Okay, and maybe that goes on for 10 more years. Maybe not. I mean, think about this. How many times have we talked about like small caps have underperformed the market? 5 years ago, small caps underperformed the market. 6 years ago, 10 years ago, for over 10 years they've underperformed the market. So to me, I'm just saying.
Aren't they outperforming now recently?
Recently, right?
Yeah.
But they're so far behind.
Yeah, right.
They could outperform for the next 10
Yeah.
years and not even catch up. So all I'm saying is, why don't we just say we're in the market?
Yeah. And Walter Scott's going to present in February. And what we can add to the work plan for this year is a review of the international equity structure to incorporate owning the market and show you what that looks like in terms of portfolio characteristics and try to understand and make sure that if you go that way, that we construct a portfolio that is style neutral, owning the market and core, so that you're not making a bet on value stocks or growth stocks.
What do you see other defined benefit plans doing in that regard?
So I think the one nuance with Norwalk versus a lot of our clients is that you have developed managers and emerging markets managers. And a lot of our clients utilize managers that invest in both. So they're benchmarked to the ACWI ex-US, which incorporates both international developed and emerging markets, and it gives the manager the discretion to invest within guardrails as much of emerging markets or as little as they want. So
What index do they benchmark against?
typically the ACWI ex-US index, MSCI ACWI ex-US. So
Which is a blend of
which is a blend of developed and emerging markets.
Emerging, yeah.
Exactly.
How's it weighted, you know?
It's market weighted. So emerging markets is probably 30%.
Yeah.
Around there.
Yeah. Okay.
So that would be the one kind of thing I would point out.
Mhm.
It doesn't mean that this structure is
Yep.
wrong or broken.
Mhm.
But so adding an index like that, passively invested, where you don't have standalone emerging markets,
Yeah.
could be an option. And we would just want to review it formally with the board and make sure that everyone is convicted with the same strategy going forward so that we can implement it appropriately.
And we've had numbers to compare in the past, whether it was active managers versus the market itself. And historically, the active managers have always outperformed, by this percentage, by this percentage, by this percentage. I need to see some numbers like that to convince me that we need to stop.
But that's not really true, because that's why we shifted into putting money into index funds years ago, because they consistently underperformed.
That's in one area.
Well,
Is it across the board?
But in the United
No.
States stocks, the biggest position we have is in equities, right in the Russell 1000 index.
Yeah.
And we put the money there because the people who are running the money weren't doing well.
Yeah.
Right.
So
But I think
all
here's
we're
the point.
doing is saying, okay, and it seems to have been a good strategy to change
Mhm.
with our US equities. Perhaps we should also be changing in other areas.
Yeah. I think
But
I
that-
agree with Kevin's point, though, that there should be more of an opportunity for active managers to outperform in developed and emerging markets, where
And
the
historically,
information
that's
is
what
less efficient and all that stuff, whereas the US equity market is so analyzed, it's analyzed to death, So
Well, at least they haven't been doing that.
who hasn't? But yeah, the international and developed, yeah, right, yeah. Or they've been in a bad cycle or whatever.
Like for us, is it for us to say, oh, I think we should, in a sense, like you're talking about Walter Scott, and say, okay, are we, by saying we're putting money in Walter Scott, we're saying we believe that, long-term steady growth stocks are the place to go. So we're making a value judgment, or should we simply say, I don't know what is the best segment of the market. So what I'm going to do is I'm going to say, you could be we're going to just be in the market.
And that's fair.
To me, I didn't follow the logic on what you said. Team's good.
Well, I think there's market dynamics at play where the fundamentals of companies aren't necessarily getting rewarded.
Right.
So when they buy a company who has everything on paper is very strong and all of the money going into a market is buying another company and there's declines.
How does that not redound to them?
Well, the problem is that they've done terribly because
That's what
of
I'm
that.
saying.
Right, exactly.
Yeah.
And we could argue all day about whether it's sustainable and
Yeah.
will this persist? And the reality is I have no idea.
Yeah.
Britt,
Thank
if
you.
I could
Thank you.
But
jump in.
Please, Kevin, please.
Yeah, I think that there's a timing element here. So one of the things that I always think about is when you decide to engage with an active manager, I do think that there needs to be a commitment to a certain period of time, because managers and strategies are in and out of favor. That's always going to be a reality. And there's an unfortunate timing here in that Norwalk engaged with Walter Scott at the absolute wrong time in terms of the market headwinds. And had they engaged with them previously, because I'm sure a big part of the search process was their historical performance, then it'd be a different experience. So if you had 2 years of really strong performance and then they hit struggles in terms of headwinds for years 3 and 4, my guess is that we'd be willing to give them more leash than we currently have. And I just want to keep things in perspective. You know, the old adage, we talk about a full market cycle is 5 years. We're nowhere near that with Walter Scott. And so my hesitation is just we've lived through the downturn here in terms of the struggle with them, and that we're not, staying true to the commitment at the onset of the relationship, and where we'd be exiting at prematurely at a bottom. Now there is a hypothetical. We can play the hypothetical game all day in terms of it continues this way, but outside of there being no change to the philosophy and the process which we bought into initially, I hesitate to make a change. It's another thing if we see team departure, if we see asset outflows, the FBI raiding their offices, right? Like those are the really meaningful issues. But I just hesitate to make such a drastic change so early on in the mandate.
One of the things is you use the word hypothetical, it might continue, and it's also hypothetical that it might change.
Right.
But one of the things is this, Dave, you should tell your brother that he did a good job, because when he was on the board, he and I were the ones who were most opposed to putting money into private equity. And now we look at private equity, and guys they'd come in here and say, well, oh yeah, we're going to be out of this thing in 7 years. So we put money in the 2014 fund. We still got money in there, and it's 11 years later. And they're going to close down the VA fund. That money might have been in there 20 years. So,
Yeah.
So we evolved into saying this is no longer a place we're going to invest. And I think we'd all agree that that was a good decision. And I think also to say we went into passive US stocks, it seems like that's been a good decision. So evolving into some of these things over time, and this might also be a field to say, okay, it's time to do something.
So on the comment that evolving into passive on the US side has been good. Do we know, can Callan show us the performance of active managers that are in your record keeping system versus the Russell? There's something that'd be something that'd be interesting to see. Is it true that we have the Russell done better? I don't know.
And you're talking about the Russell 1000.
Yeah.
It's in large cap. Almost, and I'll show you this more in the DC report. Active managers have struggled mightily.
Okay.
Mightily. To the point where I think the entire industry has shifted away, except for defined contribution plans, as a way to provide participants with options. But I think in terms of active management in large cap stocks.
Well, I gave you the name of the guy, but we can't put money into it because he's one of my best friends. Seriously, he beat the market last year by 150 basis points. He runs $15 billion. But we can't.
What's his strategy?
He trades like crazy. He really trades.
So he does his own stock research or not paid?
He's got a team.
But maybe our takeaway is, so we put together each quarter active versus passive slides for each asset class, and these measure rolling 3-year periods over the last 20 years. So it's really trying to get an understanding of how persistent is active management outperformance by asset class, and if it's not, then most clients will go passive. And so maybe to start, we can review the asset classes in the
Isn't it only 20% outperform the market now? Active managers.
It It depends on the
asset.
space. Yeah.
CSP 500.
I would say less than that.
Yeah, so
But
Say
in
again, Kevin?
international, I would say it's much more persistent.
But that doesn't apply to the other, like, so the numbers that Jim, you're talking about will support that active management still adds value in places like small cap, international, emerging market, and that by and large, most of our clients are active. It's very, very few, frankly, that I know of who are passive in places like international or small cap because the numbers are telling you active
More compelling.
management is still
That's
supported.
because of the inefficiency of those markets relative to
Exactly.
the US.
That's right.
So maybe we can bring back those slides to show you what we are referencing and we can plan to review the international equity structure in the spring more formally so that we can understand some alternative structures, what it would look like if, ultimately the board decided that active management wasn't the way forward. And we can
are there reasonable ETFs in?
So we wouldn't, ETFs and kind of institutional pension plan have not really taken off. But there are plenty of the passive providers, State Street, BlackRock, Vanguard that offer index funds at very reasonable fees.
But I mean, of international stock. Yeah.
Okay.
Absolutely.
And how far would you go down in the asset class? There are 8 or 10 categories.
So we
US large cap.
We do virtually every public market benchmark. So we can show, every asset class that the pension plan has. We can show you, we can give you the whole deck and it'll put you right to sleep. But
Okay. All right. Yeah.
but yeah, we'll bring that to the next meeting and just to help everyone understand kind of why we think active management in certain places makes sense. It doesn't mean the experience with the pension plan has had that, but that really backs up kind of.
Maybe we got the wrong guys advising us.
Well, maybe we had bad time.
Well, we got a contract.
Maybe we had bad
Which I
time
was
picking
all in
Water
favor
Scott.
Is there a passive consultant? Is that enough?
So we have
See, this is where we don't want to be on the tape. We want to be able, if we still had the person recording here would say, we're just kidding. So I want to say, we're just kidding, tape machine. Okay.
all right. So we have Water Scott next month and we'll
Yeah,
drill into that and then we'll
do some.
take another 2-3 months after that to go through this. Yeah, okay.
Besides I'm getting older now, I'm becoming more senile too. You guys have already demonstrated it tonight.
All right.
Okay, just don't care. By comparison.
So what about, so we're finished basically with the review at 26? You want to go into any more? We just, nope.
I think that's great.
Well, we just added this.
Yes, we added
Active,
the
passive
active
thing.
passive.
Yeah.
We'll circulate the updated
Yeah.
version.
Yeah. Perfect. Would I go on the performance review for last month or?
I'm happy to.
Okay.
Should be on the second tab in the hard copies, the November flash report. Assets almost 600 million. So the pension plan, despite 3 million going out a month, continues to grow, which is great. In terms of the asset allocation versus targets, continues to be a bit of an overweight to US equity, 37.5% versus 35% target, given how well markets have done in the US. Underweight to fixed income, 16% versus 19%. But largely all of the asset classes are close to target and well within their ranges. Then on the next page showing performance. So I mentioned it earlier, you'll see LSV has underperformed over the last year. Again, largely driven by the dynamics within small cap stocks and negative earning companies really rallying in 2025 and outperforming just about everything else. So, longer term LSV's done a nice job for the pension, outperforming over the 5 and 7 years. Principal, again, transition is in process, but they've had a nice trailing year, so good to see their performance bounce back. Silchester within international equity has underperformed the value index over the last fiscal year and trailing 12 months. That is largely due to the huge allocation of financial stocks within the EFA value index. So Silchester has an underweight to financials. They simply won't own the number of financial stocks as in the benchmark, which is really driving their relative underperformance. They've done much better versus the EFA index, the broader index, as you can see right above it. Firm team continues to be strong and stick to their intrinsic value process. We'll hear from Walter Scott next week. ABS, I mentioned earlier, has done very well, up over 14.3% for the trailing year, ahead of their hedge fund peers. So good to see them performing well and providing a bit of diversification within the equity portfolio. I know Frank mentioned it. The Pantheon Europe Fund 5 we got notice that they are winding down the fund finally. So for those of us that weren't here, that commitment was made at the end of 2006, believe it or not. There's 220,000 roughly remaining. It remains to be seen, what of that remaining value will ultimately be distributed. And we would expect the USA Fund 4, 6, and 7 to largely continue down that road of a similar process of winding down, given their vintages.
So we could, within a year or so, have just the basically almost the 14.
Yeah, I mean, for all intents and purposes, that's all
That's
you
what we have now.
now. I mean, we're certainly tracking the other funds, but the global fund has $6,000 in it. Fund USA 4 has 20,000. So those funds have.
And none of those funds are paying fees now, right?
I don't think so.
No.
And all the value creation has already been had within those funds. So, I think the 2014 fund is ultimately the pension's really last remaining commitment. The fund is doing fairly well, continuing to make distributions. So that's good. And on the last page, just looking at the remaining asset classes, fixed income managers. Prudential has done a nice job outperforming the aggregate index, up almost 6% over the trailing year. UBS, who we hope to have in maybe in March or April, they had the 2.5% loss in September, given the write down of their co-investment with First Brands. They bounced back. October, they were up 1.5%. November, they were up 0.5%. If we take out September, they're in line with their peers. So it's unfortunate that they made such a costly mistake. But you can see over the 3, 5, and 7 years, performance for them has been competitive. And then lastly, PIMCO has done very well. You see up almost 8% fiscal year to date and up over 13% for the trailing year. They have some emerging markets equity in there, which was the best performing asset class in 2025, despite the tariff concerns and everything we read in the newspapers. So good to see PIMCO performing very well.
They're beating their index quite a bit too. Is that the best index for them, or the best benchmark for them?
Well, it's a difficult one because there's so many allocations within that fund, both within fixed income diversifiers such as commodities, and there's equity, and ultimately there's not a real multi-asset class benchmark that can be constructed to monitor them. We think CPI plus 5 is probably a reasonable target. The Bloomberg Tips Index is really not what's in the portfolio. So,
Okay.
we try to benchmark them to both, but, ultimately, and we'll have them in either this year or early next year. It's a very complicated product with a lot of different allocations under the hood and
It's PIMCO.
PIMCO.
Right, they had that
Exactly.
three-legged stool, but I mean, to me, when I look at PIMCO, bottom line is they're doing better than our bogey. That's all. I mean, if we have an assumption of 6.5% and they make it over 7%,
That's fine.
I don't need somebody to make 20 who might lose 10.
And that's
Also-
why CPI plus 5 we think
Right.
is a reasonable.
Yeah, and
Also,
that seems.
interesting to note that fixed income almost made our bogey.
Yeah,
So,
well, almost.
but
Over the last 7 years, though.
well, we got, there was a year or two where
Well,
fixed income and equities were down. Now we've had a year where they're both up nicely, right?
Yeah.
So,
well, Trump's gonna push rates lower and then we're gonna have more inflation and then somebody's gonna have to raise rates. That's what I think.
maybe.
I'll pause
I mean,
there.
people forget the dollar was down 10% last year.
Yeah.
So if you were if you were a foreigner buying US treasuries, you got hurt bad.
Mhm.
Any questions on the performance?
That's good.
Okay. Anything else anybody would like to discuss? If not, is there a motion? First of all, hello, Ellen. We didn't see you earlier. It's nice to see you. Is there anything that anybody else would like to discuss? And if not, is there a motion for adjournment?
Thought we had the defined contribution.
Yeah, we have to do that. Yeah, that's a separate.
New schedule now.
Right.
Charles Puro, moved to adjourn.
Jim Hendrickson, second the motion.
All in favor?
Aye.
Opposed?
Aye.
Motion passes unanimously. Thank you very much. Okay, defined contribution. I'm gonna call the meeting to order. Have a roll call.
Jim Hendrickson's here.
Charles Puro in attendance.
Raleigh.
Frank Nash.
Britt Murdoch with Cowan.
Okay, Dave. Step
Dave
up.
Kramer. Dave Kramer.
Kevin Schmidt with Callan.
Jared Schmidt.
Tiffany Lamb.
Okay, minutes from the last meeting. They're pretty simple.
I read them earlier. I have no. The motion to approve the minutes as Jim Hendrickson, sorry.
This is second.
Bob Ellen.
All in favor?
Aye.
Aye.
As you did the last, I'll abstain because I wasn't there.
Right, one, right.
Were you there?
Support, yes. Well, no, not the meeting, actually, December.
Yeah, then you
Right,
should.
I should abstain, so all in favor, aye, just 2 abstentions. No no's, passes unanimous of those voting. Is there any public comment? Without any public comment, we'll go to reports. So take it away.
Excellent. So the last tab is the hard copy. I will start on page 26. Showing the asset distribution of the 401(a) plan. Which is up to 28 million. This is the main savings plan for employees in the city. If we turn ahead to page 29. I'll show that, 87% of the assets within this plan are invested in the target date fund, which is great. And you can see new contributions in the pie chart to the right. And almost as much, over 80% of participant contributions is also going to the target date funds. So good to see strong usage of the target date funds within the 401(a). And then on page 31, detailing the 457 plan, assets about 62.7 million. As this plan is also continuing to grow. And we show on page 34, the asset allocation where about 61% of assets are in the target date funds, followed by the equity funds. And in terms of where new contributions are going, about 40% going to those target date funds and about half going to the equity funds. We have performance. Any question?
Oh, no, so we have about $90 million, no, 48 and 62.
Yeah. I mean, the 401A has grown from 800,000 to 28 million in no time.
And is the city now contributing 6%?
Yeah.
Yes. Yep. But the employees still at 5. Thank you.
So on page 36, we have the performance of the capital group target date funds. Performance for the quarter is positive from an absolute perspective. You can see returns ranging from about 3.2 to about 5.5%, 5.75%, excuse me. Most of the vintages underperformed their benchmarks largely due to an underweight to small cap equity versus their peers. We did see small caps bounce back a bit. Longer term, the funds have done extremely well, ranking in the top quartile or decile virtually across the board. So it's great to see target date funds performing well.
Would you say these are these entirely active, or are they kind of a blended, they're more managed passives?
Mainly active.
Okay.
Mainly active.
Wow.
Across the board, or yeah, okay.
But these target funds go up to 2065.
Yeah, we just added those, right?
Yeah, wow.
Yeah, we have clients that have already added 27 funds.
Yeah.
What's the expense on these?
It is. I think the average expense ratio is 35 basis points.
So not
So very-
high, but
Well, for active funds, very competitive.
Yeah.
low. Oh,
Yes.
yeah.
Capital Group is very known
yeah.
for having extremely competitive fees. Like we show on page 47, the median fee is 45 basis points, so well below that.
Has anyone cooked up index funds like target
Performance is good, that's for sure.
Yep. Yeah, I mean, the biggest target date fund providers are Vanguard by tenfold, probably.
And these are
State Street and BlackRock.
those are
All passive.
Wouldn't it be just an ETF for stocks, an ETF for bonds?
They're just buying the benchmarks.
Yeah.
Yep. They have their own unique glide path,
Yeah.
mix of equities and bonds, but it's very low cost. I think you see a lot of clients do that, especially in the corporate side, where fees are under extreme pressure from litigation. But you know, I think ultimately the capital group funds have done very well, even when you compare them to their passive counterparts.
Okay.
They come with their own challenges, particularly Vanguard. Tracking error can be an issue. They're so large that in rebalancing becomes an issue at times. You're almost trading against yourself, and there's just growing assets there. So just something to be aware of.
Yeah. Okay.
Then
So go ahead.
we have the individual options on page 37. So if you recall, a full suite of passive or low cost options are offered. You can see all the BlackRock equity funds on the Fidelity Bond Index. Those funds are tracking their benchmarks reasonably well. The active equity funds, we were talking about how active management and large cap has been doing. The JP Morgan Equity Income Fund has actually done fairly well. You can see 9.9% for the trailing year, in line with its median, outperforming and reasonably close to median and benchmark over longer periods. But if you look at MFS large cap growth and look at the Russell 1000 growth index, and the little number next to the Russell 1000 growth is their peer ranking. And it's top quartile across the board and in the 5th percentile over the last 5 years. So there are not many funds beating them. Specific to this MFS fund, they're underweight to technology stocks, as a lot of large cap growth managers are, and they don't own Tesla. And that has
It's only 300 times earnings.
But that is directly contributing to their underperformance. And it's really like that across the board. If you have a slight underweight to one of those 7 or 8 names and it goes up like it's been going up, you get whipsawed.
Yep.
GW&K, the mid cap equity fund, their underperformance over the last year again is largely contributing or attributable to those negative earning stocks rallying. So the highly shorted stocks, the negative earning stocks that are outperforming, those with strong balance sheets, longer term, more competitive. We do still have conviction in this fund. And ultimately, their experience in 2025 has really eroded their strong track record. TCW, same fund as in the pension, has done okay. Slightly underperforming over the last year and outperforming over the last 3 years. And then finally, the stable value fund from Invesco has done very well, ranking in the top decile. It's underperformed its T-bill benchmark, as have all stable value funds, given the short end of the curve and the inversion of the yield curve. But as rates come down, stable value returns will certainly catch up.
Because one of the things is the money in the defined contribution has grown. When we first started, we had so many, there were like 50 or whatever, some enormous number, and we trimmed it all down because we said, okay, the amount of money we had, but now that we have more money, and I'm not advocating that people put money into any fund in particular, but should we have an opportunity for some people, if people chose to say be in a precious metals fund, or be in a commodity fund, or be in some other kind of a fund like that, because now and I know most people are doing, like you said, and I understand that most people are on the glide path and that's all there is to it. But should we now, just like we contracted the number of options, should we start maybe gradually expand it?
So in terms of the number of options you offer, so you offer 4 passive funds, 4 active equity funds, so 8 and 2, call it fixed income funds, 10, plus the target date funds, 11. That is about the average number of options that we see in defined contribution plans.
I would think we'd have a handful of people that would want to get into commodities, I think. I'd be surprised if there's more
And the way you could
a really small number.
the way clients have explored doing this is a brokerage window, which essentially allows participants to pay a fee and they can go in
Whatever they want.
and
Do anything they want?
however, the brokerage window opens up a lot of interesting things for people that know what they're doing. But what we often see in brokerage windows is retail share classes of an S&P 500 index fund. So instead of paying the 5 basis points for the one offered in the plan, they're paying 25 basis points for the one in the brokerage window. So we don't necessarily always see great understanding and utilization of the brokerage window.
Yeah.
But certainly, if you want to offer more choice, that's typically the avenue, and not adding more to the lineup than the core building blocks for a portfolio.
The other thing I'll note is that within Callan's supportive of a diversified real assets option that has beneath the hood things like TIPS, REITs, commodities, almost similar to the PIMCO fund we were talking about earlier in the other meeting. What we are not supportive of is when those underlying strategies are offered on a standalone basis, because historically there's two things. One is that our annual DC survey can speak to this, but there's little uptake in them on a standalone basis. And also we found that participants use them incorrectly, and they often become kind of trading vehicles, right? There's a lot of behavioral aspects around these strategies, and we have to think about the participants as a whole and whether or not we're getting optimal behavior or optimal performance from them. And we do see them, unfortunately, used in a tactical sense, and oftentimes participants, frankly, are shooting themselves in the foot because they're not all as perhaps well educated as they think they might be. And so when they see gold running up, and then they lump into gold, and they move all their assets from the target date fund to gold and try to capture that and time it at the exact.
And it's kept going up.
Yeah,
And
so
the same with like standalone emerging markets equity funds.
No,
where
I mean, the only
people chase, and
Yeah.
is it really?
yeah.
If you're looking at this as a vehicle to retire in 40 years, is it gonna?
The right strategy.
What about even having, say, I mean, we used to have money in commodities
Mhm.
in the plan,
In the pension.
in the pension, which the guy, I remember him being there and he decided to do spreads.
Yes, I remember.
Oh, Christ, I mean, they're going like, and by the way, he was buying platinum, selling gold. Right now, platinum trades around 2,200 and gold's 4,600. I guess that wasn't such a good idea. And he basically lost we were done, but say, should maybe we put Silchester in here?
I don't know that you can.
Okay,
I don't know that they have a vehicle.
right, I don't know this, right, that's all I'm asking, I guess, something like that. I'm just saying, is there another place? If I mean, to me personally, market's been up a lot, 3 years in a row. Every house on Wall Street has said the market's gonna be up again this year, and maybe it will be, but maybe it won't. And maybe inflation is a problem, and maybe it isn't, but and that's not for one of the things about defined contribution is we don't make that decision for people, and I'm glad we don't. However, we might say that some of them would be very naive and make mistakes, but some may not be, and should they have the opportunity to make decisions differently. That's all. That's why when I asked about Chester.
Yeah, I think our offering is reasonable right now. If we were to add something, I think the real asset thing that Kevin mentioned might be an option to include some of the things you're talking about. And it's relatively safe stuff.
Right.
Long term. But I wouldn't want to get this thing too complicated, and I definitely don't think I'd be in favor of brokerage window. I don't think there's enough demand for it.
I think we reviewed the investment structure, which is essentially the lineup. I want to say 2024.
Yeah.
So maybe we can add this to the list in early 27, where we take a fresh look at it and see if, real assets or quasi-inflationary hedging option is worthwhile. To Kevin's point, I have a number of clients that offer options like that. Billions, tens of $billion plans, and 0.1% of assets tends to be in them.
Yeah. Right.
So just with that caveat, it's really not utilized even in financial services plans where
Yeah.
very sophisticated people are investing. So we're happy to revisit and look at, potential changes to the lineup and see what works best for the committee.
Okay. Yeah. Good.
It's interesting to see also that the passive funds here, even the international one, outperformed slightly the active fund in that area. So you can the BlackRock MSCI versus the MFS International Diversification.
Yep.
On the target date funds is so Callan has their own index, right?
We do. So
And you ever compare that with, I guess the other index is Vanguard? I mean,
So essentially what we're showing on the performance summary is, so the AF target date vintage index is Capital Group's asset allocation on the glide path, but passively implement. So it's just the benchmark performance.
okay.
And then Callan's target date benchmark is essentially the average of all off the shelf. So it's the median peer,
Got it.
what that return was.
And they're pretty close.
Yeah, and I mean, over longer time periods, largely the funds have done very well.
This would be for the two of you, staff, but they changed the rule. It used to be that you had to stay in 5 years, right? To get fully vested in the defined contribution, but that was changed to
2 years.
to 2 years.
Yeah.
Wow. Used to be 10 years around.
Most companies have gotten rid of it.
Yeah.
As in,
So like the gentleman whose name I mentioned before, because I don't want to put it on here, who left, right? He wasn't here for 5 years, but he would get the money that he contributed and what was contributed.
Just his contribution,
Yeah.
not the employer.
He only gets his contribution. He doesn't get the matching funds. If
Correct.
he leaves
Prior to,
prior to 5 years still.
no, right now it's
right,
2 years.
2 years, right. So he would have got the funds for, if he was here more than 2 years, okay. Which probably makes it easier to hire people. Right?
Yeah,
Yeah.
it's a better benefit, so.
It's a better benefit,
Yeah.
right?
Yeah.
That's good.
Yeah.
Okay. All right. I'm glad to know that. Are there any other changes in any of the contracts that we as a pension board should know of? There be any, if any significance into funds coming in or funds going out?
No, no, in the defined contribution plan, no.
Okay.
And in the pension plan, there were some fairly major changes to fire and police.
Would they affect us or not?
They affect you, it has a financial impact on the benefits are better and it has a financial impact.
It would affect the actuarial assessment,
Yes,
but not what we do.
yes.
Yeah.
Yeah, nothing profit wise or anything like that.
Is that just like a change in, say,
So in a nutshell, there was a change in the benefit plan for fire and police at the start of, I think, 2013. So any employees hired after 2013, they scaled back the benefits. And that change has been in place in a number, and probably like 6 or 7 different ways that the benefits were scaled back. Those employees, we have more of them now. There's more of those employees, and so I think there was pressure and there were some morale issues in those departments because they were getting a lesser benefit than the older employees, and so they argued that there should be parity again between the two the two sections of employees. And so that's what happened. Basically, they returned the benefits for those newer employees to the same level as the older employees, and everybo's pretty much getting the same.
And would that affect, I mean, if they were getting fewer benefits for the first, say, 10 years of their time, does that affect the outflow from the pension plan?
We'll have
Yeah.
better outflow, yeah.
Yeah. We did some other things to offset that, not fully offset it, but we made some other changes to. So for example, in the police and fire. In the police and fire plan, they're required to make a lump sum contribution over a period of 5 years.
Years.
Over a period of 5 years, I think it's $10,000 over 5 years as a way to offset that. And so that was one example. On the fire side, police have more opportunity to make up that lump sum contribution through overtime.
Mhm.
So that was easier for them to absorb. On the fire department, they don't have as much opportunity for overtime, so we did something different with them. And what we did there was that we increased their copay on health insurance. So it doesn't directly affect the pension fund, but it does affect the city's overall budget.
And I probably should have asked this question in the prior meeting, but do you need any money?
No, good for
I
now.
didn't think so. Anything else for anyone?
No.
Is there a motion for adjournment?
Jim Hendrickson, I'll motion to adjourn.
And is there a second?
Bob Raleigh.
Okay. Any discussion? If not, all in favor? Aye.
Aye.
Opposed? No.
Aye.
Thank you very much.
Thanks,
Night,
guys.
everybody.
Thank
night.
you.
Night.
Thank you, Al. Thank you, David.
Thank
Enjoy
you.
your skiing.
Thank you.